Welcome and thanks for joining. I'm Ross Bramwell from Hammerberg's Investment Department, and today I'll briefly discuss the impact of money supply on inflation and how the Fed is using money supply in its battle on inflation. Given this month's better than expected jobs report and persistently low unemployment claims, what appeared to many as an inevitable recession in 2023 is less certain today. Still, there are several indicators that we monitor that suggest that economic and employment growth should slow. The yield curve is inverted. Estimating earnings growth for 2023 continues to decline. Earnings surprises and pre-announcements continue to be mostly negative. Consumer stress, as measured by food, gas, and mortgage rates, is elevated, and banks' willingness to make loans has decreased considerably. And as far as it relates to looking to the future for employment and capital spending by businesses, is the fact that profit margins have fallen 1.5% already. Historically, declines in profit margins of 1.5% or more have been consistent with recessions. But we know history does not just repeat itself. Stocks are currently telling us that perhaps these common indicators may not perfectly apply in today's environment. If we can avoid a recession, it will likely be due to at least one of the three reasons below. Inflation possibly declines quicker than expected. Maybe the Fed gets comfortable with inflation above its 2% target. Or maybe companies prefer to take a hit to profit margins and earnings as opposed to laying off workers that may be needed in the future. Of course, no one knows if the economy will end up in a recession or exactly when. However, we do believe that the end of the Fed's accommodative policies of the last decade means that quick recoveries in the economy and the markets are less likely, as we believe the Fed will be hesitant to renew its accommodative policies and possibly start a new inflationary period. Here we have a chart that shows the monthly year-over-year change in money supply, or specifically M2. M2 includes cash and other liquid cash-like assets in the economy. As you can see, the increase in the money supply during the pandemic was fueled by the Fed's accommodative monetary policy and Congress's fiscal stimulus from direct payments and unemployment assistance. The change in money supply also offers an overview of inflation levels, because if the money supply is increased, inflation could rise. Equally, if the money supply is restricted by the Fed, inflation could fall. However, it is generally accepted that there is a lag of between 12 to 18 months for inflation levels to respond to an increased monetary supply. Now that's key. To be clear, the Fed raised the Fed funds rate about 4.5% last year. While the housing sector was hit quick and hard with higher mortgage rates, much of the impact of those rate hikes is still moving through other areas of the economy. This chart illustrates its principle as inflation increased when the money supply ballooned during COVID, but the money supply peaked in early 2021, while inflation did not peak until almost 18 months later in the summer of 2022. Inflation has now decreased 7 months consecutively, but this is well after significant decreases in the change of money supply had already occurred in the summer of 2021. So how does the Fed influence the money supply? The Fed can influence the money supply by providing stimulus into the economy or by incentivizing people to spend less. Quantitative easing, or QE as it's often called, is one way that the Fed has increased money supply and stimulated the economy during the pandemic. Central banks can also increase or decrease interest rates to influence the money supply, which is what has happened in dramatic fashion the last year. If interest rates are lower, borrowing will become more popular, which will increase the money supply. If the Fed raises interest rates, then the cost of borrowing goes up, which will deter people from taking out loans. This will decrease the money supply in an economy, which is what we are currently experiencing. The Fed is hoping higher rates deters borrowing and lowers demand to bring down inflation. The markets have recently shifted closer to the Fed's message of higher for longer rates. However, we still believe that we have not seen the full impact of last year's rate hikes and of the smaller additional rate hikes this year, which we believe are still likely to weaken U.S. consumers. The change in year-over-year money supply is now negative. Although the stock market has rebounded to start the year as it anticipates the Fed is close to ending its tightening policy, we continue to watch the economic data to see if the jobs market and U.S. consumer can sustain their strength as the full impact of rate hikes work their way through the economy this year. Hey, thanks again for joining. We appreciate your time. If you have any further questions or would like to discuss it further, please reach out to a member of your client service team.